Hello everyone, and welcome back to Southern Wealth. I hope you're having a very good week. If you do enjoy the content, please consider dropping that a like and subscribe. So thank you very much for your support. Tomorrow evening, I will be doing a live stream. I will set it up today, and you can see what time I go live. If you guys have some questions for me, come prepared. That would be great. If not, just watch it. If you do like it and you think there's value there, just also consider subscribing. That would be very helpful. So, what's happening? Markets keep very volatile. At some point, they were very negative today, but now they're pretty much flat. Russell has been the outlier. It has been the outlier on the downside, but it seems to be also an outlier now in these more volatile days. Bonds keep going down, which eventually will always, if they keep that pace, will always impact other markets, as you know. And you see, here's the important thing that many people miss. The natural movement of bonds is actually down. Why is that? Well, if governments keep on piling on debt and deficits, then your levels of debt keep increasing, so you need higher interest. Why? Because since you're accumulating more debt, the likelihood of you defaulting is increasing. So if you let things natural and normal, rates will always keep on rising. Now, what has been different lately? I mean the last 10, 15 years, is that the Federal Reserve would come in and buy those bonds. So it would create an artificial buyer in the market, pushing down the rates and giving the impression of a lot of demand. Also, other countries like China used to trade with the US. So the US gets the goods, they send over the paper, they take those dollars and they buy stocks and bonds in the US market with that money. Of course, that is changing as countries are looking to de-dollarize. So you have three people selling bonds: the Treasury in the US to cover up the deficits, the Federal Reserve, which is continuing its tightening, and allies and enemies alike who want to get out of the dollar. So that's why anything causes a huge pressure in the bond market. Now, the issue is the bond market touches the other markets. Not today, we're still fairly either up or at least stable in the stock market, but eventually, if you let it too long, it will start impacting those markets as well. But today I've seen something which is very important. I've seen on CNBC's website that basically the top economists now all unanimously agree higher for longer rates. You remember the first time I said that? It's back in June. That was 4 months ago, right? But where they were all thinking that we're going to be cutting rates now. I said, no, that's not going to happen. Now, these same people were projecting a recession, so that was the reason why it did not happen. And now all of them are convinced that there is no recession coming and that rates will stay higher for longer, which is starting to make me feel that maybe by beginning of next year, maybe first quarter, we're going to start to see the first rate cuts. We'll see if that happens. But you see, like people ask me, but what kind of signs are you looking for? But I say, this type of signs, when all these economists who are always wrong unanimously pile in what they think is something's going to happen, that to me tells me, okay, then that most likely means it will not happen. Now, we continue with the same debate, which is, okay, and by the way, when retail sales came down, and they came down very, missing the mark, of course, stocks rally because bad news in the economy is good news for stocks, because bad news means lowering rates, which means higher stocks, right? That's the trade. And what's been happening is, and in my opinion, will continue to happen for a few more weeks until we have a decisive statement by someone, is on one side, You have the economy and the job market still hanging on well, and the inflation numbers coming hotter. On the other side, you have conflicts, which typically require aid. Well, but aid means turn on the printing machines and let's pump. So there's a fight, I think, between what's going to prevail here. The war more important or hotter than expected numbers? I have my theory now that I'm starting to see everyone thinking that rates will remain higher and that basically, it's impossible to have a recession. That is the kind of environment that makes me think that maybe by March or so next year, we will be back to cutting rates once again. We'll see. But in any case, guys, thank you very much for your attention, and I'll catch you in the next one.